So there's a few steps in the pathway to buying your first home. Probably the part that people are most excited about is picking the property, browsing real estate or domain, things like that. But before you get there, there's obviously the hard slog of saving a deposit, getting your loan, then choosing the property, and then all the legal stuff, offers, contracts, settlement, before you can finally move into that home. And there are a few professionals to help you along the way with the different steps. So an accountant can talk about the tax benefits and the government concessions that are around to help you buy the home. You're going to need a mortgage broker to get the finance. You might need a property advisor to choose the right property, and then a conveyancer to do the legals. So today we're going to have some speakers in some of those, or three of those different areas. So firstly, Greg Caruso will talk about financing your first home, Paul Ianello talking about the government help for first home buyers, and Philip Almeida talking about the do's and don'ts of choosing your first home and just the market generally, which I think is the big unknown in buying a home is buying the right home. So that's going to be really, really interesting, hopefully. But I'll start with Greg. I'll just get you on to, sorry, just let me fix up the audio. So Greg's been working in the finance industry for close to 2 decades. He started off working with some big banks like, for example, ANZ and Westpac, and he founded his own company, Jupiter Finance, 7 years ago as a licensed credit representative. In 2020, Greg's company, my company, joined forces to create a joint venture called Beyond Mortgage Broking. Greg, welcome to the webinar and thanks for your time today.
Yep, happy Friday, Jared, and happy Friday to everyone. Yeah, looking forward to today's webinar, and yeah, also looking forward to the long weekend that's approaching us as well.
Yeah. So on our pathway, we've got the arranging a loan before you go shopping for a property. So first question, can't I just wait until I find the house and then sort out my loan in between signing the contract and settlement?
I'd highly recommend always seeking a pre-approval before purchasing. One of the main reasons is, one, you will stick within a limit and affordability. You want to make sure that you can afford the loan repayment and you have enough deposit and enough to cover it to meet the purchase. Secondly, it's a bit of a dangerous game. If you purchase before an approval, especially at an auction, you can be locked into something and you potentially risk forfeiting your deposit. So arranging approval of the right bank, the right finance, and the right product is definitely essential before making any offers or going to an auction.
Perfect. And what are the main things a bank's going to look at when you apply for a loan or a pre-approval?
They're going to look at your deposit, how much you got to contribute, your income level, and also your credit history.
Yeah, perfect. Today's presentation is pretty much just those three major things. So I'll start with deposit. Yeah. How big of a deposit do I need to buy a home?
It can actually vary. The traditional rule of thumb is 20%, 20% deposit, and that's, I guess, a bit of an old tradition where people always think it's 20% deposit. But there are a few different options, and there are some different ones for home buyers, first home buyers as well. So there are some banks that will take 15% deposit with no mortgage insurance, and I'll touch on mortgage insurance a bit later. And there's also some banks that will go 95 or even 98% of the purchase price, yep. Inclusive of LMI.
Yep, perfect. So if I'm buying a home for $750,000, aiming for a 20% deposit, that'll be 150 grand. But I'm going to need more than 150 grand. So why is that?
Correct, because there's a stamp duty of around 42,000 plus. Probably add another 3 grand to that. I'd say about another 45 for general conveyancing and legal costs and transfer costs, etc. So it's not just the 20%; it's the stamp duty and other legals that are associated with it.
Yep. And we've done a bit of research and just done a state-by-state comparison. And And you can see that Victoria is the worst, South Australia
Yes.
second worst in the two. Most of our, I think 3/4 of our clients are Victoria, but obviously people looking in other states, you've got a lot less there. The New South Wales one is a lot lower than Victoria because their first home stamp duty concessions are higher because Sydney property is higher than Melbourne property essentially. But I guess the main point here is you've got to budget for more than just the 20% or whatever the target deposit is that you can work out with your broker needs to be factoring costs as well, which can be significant. So having a 20% deposit plus cost makes the loan application easier, but you mentioned there are a few strategies for low deposit loans. So talk us through these.
Yeah, absolutely. So one option is you could potentially apply for a loan up to 95%, or some banks, there's a couple that will do 98%, and that basically is the mortgage insurance component.
Yep.
And the other one is also using a guarantor, where someone else, basically, generally it's mum and dad or a sibling, puts up a collateral, either their own occupied or investment property security to cover the 20% shortfall.
Yep. And that's secured against that guarantor's home. So just to put it in a visual way, say your standard arrangement might be 80% of the bank will give you 80% of the property as a loan. You've got to find the 20. In a guarantor arrangement, you might only have 10. Yet the bank gives you 80, but the other 10, you don't need to find that money, but it's secured against, say, your dad's house or your brother's house or something like that.
Yes.
Yep.
So correct. As long as you can service income-wise, the bank will lend you. They'll first take a first mortgage on the property you purchased, and the remaining 10% or 20% will go against mum's house or dad's house or sibling's house as collateral.
Perfect. And if I have a guarantor, say my dad's the guarantor for my house, is he responsible for my whole loan or just the 10% chunk?
Just that 10% that he's willing to guarantee.
Perfect. Yeah. Cool. And the other point is, once you can actually take a guarantor off a loan, so you might get a 30-year loan, but don't need to be on there forever. Is that right?
No, definitely not. And what a strategy I normally adopt with clients is that especially, I guess, the eastern states where the properties are really seem to be going up at a rapid rate, where every 12 to 18 months I'll do a revaluation of the property. And generally what I've found is once I've taken a guarantor from a family member, within 2 to 3 years, there's enough equity in the property, clients have paid down a bit, or the value's gone up, where we can release mum and dad's property from collateral. So it's not a permanent thing, but it is a good step. It's a good assist for a first home buyer who hasn't got that 20% deposit to avoid a mortgage insurance fee. And it does help them get over the line. Yeah.
One of the changes in recent years is that the government will be the guarantor for first home buyers. So tell us a bit about that.
With that one, it's a government guarantee, I guess, scheme where it's selected with there's only a couple of lenders that are doing it at the moment, where they will, you go on a wait list and they will basically pay for your mortgage insurance. Yep,
perfect. So let's talk about mortgage insurance. That's probably the most common option people take when they've got a low deposit. What is mortgage insurance and how does it work?
Yeah, mortgage insurance is a premium that's charged by the bank. It's an insurance premium that covers the bank only, so you don't get a direct benefit out of it. But it does allow people with a low deposit as low as 5% to get into the market. It's paid over the life of the loan, so it's not an upfront fee. But and I guess the amount varies from the loan amount and the size as well. So it's a bit like a car insurance. The more riskier the car, the less you'll pay. In this case, if you're going up to 95, the premium is going to be higher. If you're borrowing 87%, the premium will drop, and it's also based on the loan amount as well.
So the bigger the deposit, the less the LMI is going to be.
Correct.
So I think you've given a range. It could be anywhere from 10 grand to even 25 grand for a very high risk loan.
Yeah. Generally, in that, depending on how much you purchase for, I'd say 80 to 90% of cases fall in the $10,000 to $25,000 zone. Yeah.
Yep, perfect. Cool. And a couple of quick questions just to finish up on deposits. So will banks count a share portfolio as an asset when assessing a pre-approval, or does it have to be cash to count as a deposit?
It has to be cash, especially if in the mortgage insurance section, because if you're applying for a mortgage insurance loan, you will need to show that you've held the deposit for 3 months in cash. So shares won't be deemed acceptable funds to complete such.
Yep, perfect. And what if my parents gift me the deposit? Does the bank look on this as being not as good as if I'd saved it myself?
That's a bit of a tricky one. At an 80% level, it wouldn't have an impact.
Yep.
But it will anything above 80%. Yeah, because you're not showing a history of that. You've saved that deposit, and the banks will look more favourably if you've worked towards getting as much deposit as possible.
And you can't get a loan from your parents to use as a deposit, can you? Because if the bank sees it as a loan, then they don't count it as a deposit. They see it like a debt, wouldn't they?
They'll factor in that as a liability, just like the credit card or a personal loan. If it's so it's ideally it's best to save as much as you possibly can.
Yep, great. Let's move on to income. So, what do finance people mean when they say serviceability?
Serviceability is your ability to repay the loan, and that depends on not just how much you earn after tax, but it also factors in your everyday living expenses and other loan commitments and obligations.
Yep, perfect. And banks like some income types more than others, don't they?
Correct, yeah. Permanent employment, or PAYG, is the most favourable, just because I think the banks deem that as more safe and secure, but doesn't mean that other forms of income aren't accepted. And overall, casual employment is a bit harder, but if you have a minimum 3-month history, but 12 overall, the banks will factor that in because it's not uncommon in today's world to have casual employment, especially if you've been in the industry for a while. So it's definitely not a no, but definitely your scoring and overall rating is higher for PAYG. And self-employed as well. So that's another option. That's probably the most challenging one at times, just collating documentation to the bank's needs, and they all have different requirements. But yeah,
it's more paperwork, but it's not impossible. I guess it's the message there.
Definitely not. Definitely not
impossible. Job
but
pays Okay.
That's obviously the easiest because it's more easy to demonstrate your payslip and some credits in the account.
Yep.
As I said, with the self-employed, you've got to get sometimes to your tax returns that do an average. Some factor depreciation, some don't.
Yep.
Some will work on low doc basis where will work on a percentage of your BAS, of your turnover. So I guess there's a lot of ways to skin a cat, I guess.
Yep. And this is where we work as an accountant and a mortgage broker, where you and I work most closely together as our self-employed clients, because we need to have the financials up to date and accurate so the bank can assess the loan correctly.
And if a client is looking to purchase in the near future, we'd probably work closely together to get a figure that work well for the bank as well. Yeah. And
especially important to get pre-approval, even more important than for an employee in that situation too, because you never know what they're going to ask for.
Absolutely, especially under COVID, where they're currently asking for trading accounts for the last 30 days and BASs to see if the business is still trading and not affected by COVID.
Yeah. So. Okay, perfect. I'll skip question 10. So the next one, serviceability is affected by other debts, like you mentioned personal loans, car loans. So why do other debts affect your loan?
Because they're commitments, and the banks will factor in all those after they take away your monthly your income that you earn from your PAYG or your self-employed. They'll factor in the repayments of that and the credit card as well. So your credit cards, say you've got a limit of 10,000, the bank will factor in a 3% repayment per month, even if you sweep it and you don't pay, and you pay it all off, and you never reach the highest limit or you don't use it, they'll still have to factor in that. As a worst case, you could go up to $10,000, and they'd have to factor in the worst possible case.
Yep. So one example was a client who had a $30,000 Amex card, which she got through a professional association as one of the member perks, and only ever used $5,000 of it, and it was actually much more favourable for her to cut that limit right down before a loan application was made. So any unused credit card limits, I guess is what you're saying, aren't helping you when it comes to loans.
They're not going to help you. It will have a significant impact, especially something like 30,000, where at 3% you're looking
Perfect.
monthly repayment will be
And just
quite high.
finally, on loans, HEX debts. Should I clear my HEX debt? Am I better off having a bigger deposit, or should I use my deposit to pay my HEX? What's the bank going to like, or is it case by case?
It's case by case of each lender, but HEX does come into it. It does, yeah. So if your HEX monthly, it comes out of your payslip, say it's 500, they'll take that out as an expense. So
Perfect.
it's one of those case by cases where if you've got enough deposit, you can leave it. It just depends what will work best, I guess. Yeah, it's case by case.
But you wouldn't say do one or the other. Cool. And then that's
No,
on
it
the
just
income
depends on
side.
the service.
On the expenses side, we've talked about loan repayments counting as an expense, but then you mentioned living costs as well. So just briefly, how do banks work out your living costs?
Yeah, so generally at this stage, they're looking at probably 1 to 3 months. They'll go by your credit card statement or your everyday general account, and they'll generally put a figure on how your spending habits are. But it's also one of those things where there is some discretion with that. So if you've had car insurance of $1,000, you're not going to pay that each month. So they'll divide that by 12 and put a premium on that. So
Yep.
but overall they'll look at your living. They'll generally ask for 1 to 3 months of statements, and they'll generally put a figure on how much you generally overall spend. So
yeah, perfect. And mostly people are renting before they buy. So does rent count as an expense when the bank are assessing your living costs? Because you're not going to have rent once you've got your home.
No, correct. So that's actually gets removed, because obviously you're going to be living into a home, and it'll just be double dipping and penalising the client for no reason. But
Yep.
just like savings and general history, if you can come up with a good few months, like if you can show the bank that you're paying your rent constantly on time, it's also quite favourable.
Yep, perfect. All right, so just to finish off, we'll talk about credit history or credit score. So give me some examples of things that can affect your credit history.
Okay. This is sometimes the thing that sometimes catch people out unexpectedly. Sometimes a default or late bills. Sometimes people unwillingly they're not aware that they've moved properties and they've left a bill behind. Those things unfortunately do come up when you apply for a loan, and it can impact negatively and limit perhaps the type of lender you can get.
Yep. And the other one is inquiries, which I was surprised by. But what's an inquiry and how can that backfire?
Look, general inquiries are okay. I mean, they do say it's healthy for a person to do 1 or 2 inquiries a year, but
And by
if you're
inquiry, you mean applying for finance, applying for a credit card, applying for a loan. Yeah. Yep.
Yeah. But when you're doing multiples at one hit, I'd say more than 3 within a 2 to 3 week period, that's going to impact, because once you get to the 4th lender and they see that you've made that many inquiries, it comes across negatively, because it looks like you're constantly getting declined, or there's an issue with that lender and you're just desperate for finance, I guess. So
Yep.
Having rapid amounts of credit inquiries at one hit can negatively impact. And I know sometimes customers are at fault, they're seeing balance transfers and they're
Yep.
thinking it's a great option. Just think about it, because multiple inquiries at once can have an impact, yes.
Yep. Yeah, so you don't shop around by applying for credit cards. You want to do your research online rather than actually every time you make the application, it's going to show up on your credit history, isn't it?
Correct, yeah. So do your research first, and then once you've narrowed it down to 1 or 2, then go through the process. Yeah, because it's healthy to have an inquiry once or twice a year, but when you're doing that so many at a rapid rate, it doesn't look good.
Yeah, and it can be accidental. They may not be desperate for money, but anyway, it just looks bad.
It does look bad.
I'll gloss over this one just quickly in the interest of time. If you go to the Money Smart website, there's links to where you can get your own credit report, and I guess that's a good way of knowing what's going to come up. So your credit report, you're entitled to get that yourself as a consumer.
Yeah.
And yeah, it's good to know what's on there, so there's no surprises, because the bank's going to see it, so you just want to know what's there.
Yeah, and any score under 600 will generally, there might be either a lot of inquiries or maybe a minor default or something on there. So it does, at least you've got a chance to potentially rectify it or call those people, and maybe sometimes people can negotiate some of those things coming off as well. So
yeah, perfect. We've kind of covered that. Don't have your any pay things by direct debit, so you don't miss any bills. You mentioned one of your tips you gave to me another time was if you have a $500 overdraft built into your account, so if you accidentally overdraw because 2 bills come out on the same day and you go under by $100, if you've got the overdraft in place, that's not a default.
Correct. No, it's not. It's not a default because you're within a limit, and it won't have a huge impact on your borrowing power. And it's a good safety net to have because we all sometimes forget that 2 bills fall on the same day, or it's
two
not about
debits come out.
and
So if you overdraw, if you get the bank's permission to go 500 overdraft and then you go under, that's fine. If you haven't set up the overdraft facility and you go under, that's a default. So it's just a little backup plan to avoid accidentally stuff on your credit score. So, Greg, what are the key messages from today as we wrap up?
Main thing is to not make an offer. Get your finance in order before making any going to an auction or looking for properties. I think that's once you have your finance in order and you know how much you can borrow and you know your funds to complete, you then know what you can shop for. Just make sure you focus on getting your approval first, and once you get your approval first, then you can really look at getting the best lender and the best possible product and rate, and always seek advice as well. So go see your mortgage broker, and it won't cost you anything, and the bank pays myself or all brokers an upfront premium for referring them to the business. So it's good free advice, and take advantage of it. So I think latest research shows that 65% of clients are using a broker for their loans, just because they can suss out various options rather than just going to your traditional lender or the branch.
A lot less time, a lot less work.
Exactly.
So if you're interested in getting a pre-assessment on a home loan or loan application, or you're getting close to the point where you want to buy, maybe you want to look at your credit record, see what you might be able to borrow, just send us an email after this session to mortgage@beyondaccountancy.com.au, and Greg can follow up from there.